again this morning on the Ag Issues program. A pleasure to bring on to the program Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, as he joins us on the program this morning. Roger, good morning. How are you?
Good morning, Greg. Good to be with you.
Good to be with you as well. Matter of fact, we'll have you talk here for a little bit longer.
Okay. You want me to switch? Okay.
This is an in-person switch here as far as... Okay.
Mic 3.
Yep, that should work.
All right, good.
All right. Now, you're much more legible. Not that you're not legible, but now you're much more legible.
Oh, we were getting the feedback. Made me sound like Charlton Heston in the Ten Commandments.
And that actually showed. ABC did their tradition of showing that the weekend before Easter.
I thought it was kind of cool myself.
Oh, yeah, absolutely. When you realize that movie next year is 70 years old.
Yeah.
But still...
Isn't that something?
It's still riveting just to watch it. So,
yeah.
All right. Now let's get back here to what we're talking about. You know, tomorrow, of course, is April 15th.
Yeah.
It's pretty unbelievable as far as anytime taxes come up, not only for farmers, but for just regular people as well. But something that came up last week, and you talked about taxes, but in Congress, there was a lot of action concerning taxes as well.
Oh, tremendous amount of action last week, Greg. And I did a 9-minute video over the weekend for my subscribers on Substack going through the 6 bills that passed the Congress on either a voice vote or by unanimous consent. So this will be, all of these will actually end up in the tax bill that comes out. And last week, the House approved the tax framework. So now, basically, we have the skeleton structure for as President Trump calls it, one big, beautiful tax bill. That's important because you don't want to do 2 bills. That's going to be really difficult to get through Congress. I think the last time they did that in terms of tax legislation, where they had 2 separate bills, was when Newt Gingrich was Speaker 30 years ago. So now they can do 1 bill. They've got the skeleton. Now they got to put the meat on the skeleton, and that's where the debate's going to come down to. But this is huge, Greg, and it's big for farmers and ranchers because TCJA sunsets at the end of this year, and we would like to restore bonus depreciation to 100%. We'd like to ramp up Section 179 depreciation. We'd like to get that corporate tax rate down to 15% for domestic production, so farms and ranches that are in C corporations that are producing things in this country, crops and livestock, would be taxed at 15%, maybe to get the capital gains rate lower and keep the qualified business income deduction at 20% for anybody that's not in a C corporation, so all those sole proprietor farmers. This is huge, plus go back to current deductibility of research and development credits, and there's an interest rate, an interest deduction computation that's in there too. So very, very important developments last week. I summarized all that in a 9-minute video on my Substack over the weekend.
But for all this to happen, this first step had to be done, though.
Absolutely had to be done. You had to have that framework done. That is absolutely critical.
Well, everything is being overshadowed right now by tariffs, and what we have seen, of course, even announcements over the weekend concerning electronics, computers, and all that. But we're not going to talk about. Well, there's a little bit we're going to talk about there, but tariffs and agriculture. There's a lot to digest in the aspect of how it's affecting agriculture.
Right, and keep in mind there's a difference between short-term and long-term with respect to the tariffs. And what this is, these are not traditional tariffs. The Trump tariffs are not traditional tariffs. They're a negotiating tool to get to a position where we actually have free trade and actually can get these tariffs significantly reduced by across the world or eliminated. That's the goal, and that's what we have to keep our eye on. Now, there'll be some rough waters to get there, so there is a difference between short-term and long-term. But in round one, it's to knock the percentages down. And what people don't realize is that for many of our ag products, other countries hit us at a much higher rate than we have. And Canada is a major problem with respect to that, particularly on the dairy and timber side of things. We've got problems with other countries that we don't tariff their goods coming in, but yet they tariff us. And then when there are tariffs on both sides, the other countries hit us much harder. So Trump is trying to deal with that issue. That's round one. Round two, then, and this will be very important, is to deal with the non-tariff trade barriers. You have countries such as Australia that make up things that, oh, no, you dip your chicken in ammonia. You can't have your chicken. We can't have your chicken in this country. Or we can't get beef into Australia because there was one cow that crossed the Canadian border back in 2003. And so, no, we don't want your beef. Or the Europeans make up things such as, we don't want GMOs. And so they have all these non-tariff trade barriers. So you could eliminate the percentage of tariffs, the number, but still have all these non-tariff trade barriers. That needs to be done in round two. I would not try to do those in round one. Then you have the big bear in the room, which is China. And frankly, if I were the president, I would go immediately to 400 or 500% on China and just be done with them. Don't mess around with them, because you increase it a little bit, they'll come back and increase it. And then you
like
go
we've
back
been
and,
seeing.
Yeah, you'll go back and forth and back and forth. I would just punch them hard, hit them once, and be done with it, because they cannot sustain it. They are far more dependent on our products coming in than we are on theirs coming in. Now, will that inflict pain? Yes. But we're in such a disjointed position on trade that needs to be corrected. And keep in mind, what we have is a president here that's trying to deal with decades of inequities on this. And more power to him. There are a lot of politicians that would never touch this. And he's trying to correct this. And this is good for people that produce things in this country. It's not necessarily good for Wall Street, but it's good for Main Street. And that's what we have to keep our eyes on with respect to this. And all this fits together with tax policy. So you got to have the tariffs, and then you've got to follow that up with the strong tax policy. So this all goes together. Plus, then you also, DOGE is important in this too, in terms of generating additional savings that can help pay for the tax cuts. And I'm starting to see people in Congress talking about that. Say, hey, we found $500 billion here. We can count that toward tax cuts. And the Senate now is using an accounting rule, which I think is the correct rule on the tax policy side of things. And that is that they're not counting a revenue loss as continuing current law. So if they continue Tax Cuts and Jobs Act, they will score that not as a change in the tax law, but continuing existing tax law. So that's not deemed to be a cut. So that's an interesting way to look at this. I think that's the correct way to look at it, but they can use that accounting method when they do tax policy.
But something like USMCA, how does that fit into all this, knowing that there are things that are exempt because of the current agreement that we have?
Right, and those things remain exempt. USMCA covered products remain exempt in this tariff discussion that's going back and forth in these negotiations. So that's a key point, and there's specific legislation that says that those are exempt from these tariffs.
Roger McEowen, professor of agricultural law and taxation at the Washburn University School of Law, is joining us. And Roger, this is the time of year as well that if you're selling your grain or livestock, deferred payment contracts, this is the usual time of year that they sign those contracts.
Yeah, that's right. We're talking tax again. We can't get away from tax. And that's one thing I try to emphasize with my students that want to go practice in a rural area, that you really need to master tax, and that can really help your practice. There's always lots of work. But you're right. This is the time of year that farmers and ranchers get into these deferred payment contracts to defer the income from the grain that they'll harvest this fall or livestock that they'll sell into next year, because, again, they've probably been doing that for a while. So last year's sales get reported this year, and so we want to push this year's sales into next year. The point on that, and I did a piece over the weekend, actually a week ago on this, just kind of reminding people that these have to be drafted properly. Be careful of boilerplate forms that a buyer hands you. Have your tax attorney or CPA or the other tax professional look it over. Make sure that you can't assign the contract. Make sure that you can't get anything from the contract this year. You have no rights to it. Make sure that there's just not a deposit in an account that you could draw on. You want to make sure that you have absolutely no right to the proceeds until next year, so that we don't have a problem with the IRS saying that you constructively received it this year.
Because, and I hate to put it this way, but that's the thing that I would think gets a lot of producers in trouble, is that they don't consult, or, they think they know, but in the end, do they know?
Well, that's an issue with a lot of topics. Particularly, we talk fences and leases. I dealt with one over the weekend, which was an oral situation, and you got to be careful with these things. I dealt with another one over the weekend where someone was burning on someone else's permit, and the fire got out of control, and so now the person who wasn't burning, but the burn was conducted under their permit, was asking, what issues do I have? Well, there are some issues there. So, yes, it does cost to get professional advice, but the question is, it's kind of an insurance policy for you. So, in a lot of these situations, but have these contracts looked over. Greg, on deferred payment contracts, there was a case that was in the tax court just a couple of years ago, and there was $58 million at issue on deferred payment grain contracts, and the IRS took that all the way to the tax court, and they were probably going to win a big chunk of that. It settled out of court, and I don't know for sure, I think that settled for somewhere in the range of $12 to $15 million of additional tax. So this is a big deal.
Yeah.
Let's get it right.
Well, let's talk about something else that's important. That's, of course, crop insurance, but more importantly, the proper reporting of crop insurance proceeds.
Yeah, here we are, another tax issue, and crop insurance is really important. It's very important in Kansas. Kansas is probably one of the leading states in terms of, well, I know it is, in terms of crop insurance proceeds and receipt of crop insurance proceeds, I should say, compared to other states. But in general, crop insurance proceeds are included in gross income in the year that they are either actually or constructively received. So we're back to this whole constructive receipt issue. But in general, if you're on the cash method of accounting, there's a rule that allows you to elect to include crop insurance proceeds in income in the tax year following your year of crop loss, if that's what you've been doing. If you've normally been deferring your crop sale income into the next year, like we just said with deferred payment contracts, well, if I don't harvest my crop but I receive crop insurance proceeds, then I can continue that same type of accounting. I can continue to defer it. One of the things on this, Greg, and I'm speeding through this in the interest of time, that gives you, as a producer, more flexibility is that if you raise multiple crops, the preferred way to do this is to have a crop insurance policy on each particular crop. Have it on, and do the same thing with your deferred payment contracts. Now, sometimes you can't do that with the crop insurance policies, but you might be able to. That can clean things up a little bit for us from the accounting standpoint. But certainly with deferred payment contracts, to switch back to those, if you have multiple crops, have a deferred payment contract for each crop. Don't roll them all together, because then that gives you flexibility to pick and choose the ones that you defer, the ones that you pull forward and report. Crop insurance, a big issue with that is, what do I do with revenue assurance policies or policies that are based on yield? Technically, those are not deferrable because the tax code says you can defer crop insurance proceeds that are paid on account of physical loss or damage to the crop. So you got to be careful with these different types of policies that are out there. Part of that payment may not actually be deferrable if it's tied to yield or revenue.
Something that all farmers run into. You talk about making an estimated tax payment each year by January 15th. Of course, one of the big important farmer deadlines is March 1st if you're going to pay income tax liability. But the qualification as a farmer is critical in all this.
Yeah, this is a big deal. No, the farmer filing, I hate to use the word deadline on this, but you can file, if you don't pay estimated tax, you need to file by March 1. We can move that to April 15 if we just make one estimated tax payment on January 15, but you've got to be a farmer to do that, and that means you have to have at least 2/3 of your gross income from farming, and that's the key. Some items of income won't qualify as farm income, such as your gains from selling or trading farm equipment, and cash rent income does not qualify as farm income. That's a rental That's a rental activity. Now, if you sell livestock, that does count as farm income. So that could mean that you may not be a farmer for purposes of being able to pay estimated tax and get off that March 1 deadline. But again, this is another thing that you want to make sure that you visit with your tax preparer on to make sure that you're doing things to the best of your advantage.
One thing I want to talk about that is not tax related, but is very important. It's the open fields doctrine, or in this case, warrantless searches that take place.
Yeah, this is really heated up across the country in many states where you have an issue that the Supreme Court gave us back in almost 100 years ago, about 90 years ago, where they said that the federal government and the state governments has to have a warrant to search your home. Well, that raises the issue, what's the extent of my home? Does that cover things outside the home that's connected to the home? What if I have a detached garage? What if I have a barn in the barnyard? What if I have a garden outside? Well, they came up with a concept known as the curtilage of the home. And they said, well, the home and the curtilage, you have to have a search warrant. Once you get beyond that into open fields, the government doesn't have to have a search warrant to execute a search. Well, we've had some problems in states, primarily with wildlife officials coming onto premises to inspect, to see whether there's illegal hunting, illegal fishing, those types of things. And this has gotten into the courts in several states, and the courts have generally ruled for the landowners, saying that when you have a property that's an interior property, where there are posted signs, no trespassing, the government has to respect those signs. And that needs a search warrant to execute a search before that individual can be penalized, either civilly or criminally. A number of states have adopted new legislation to protect those rights of those individuals. And I think this will continue to be a big issue.
All right, several other issues to talk about, but unfortunately we're out of time. But if people want to see or what you talked about today, or other issues that you discussed, they can find that on your Substack?
No, this is on my blog.
On the blog,
okay.
Okay.
This is on the blog, and I will also share this with Ag Manager over at K-State.
All right, sounds good. And the video's on the Substack?
The video's on the Substack.
Okay, sounds good. Roger, as always, I appreciate it. Thanks.
Thank you, Greg.
That is Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, as he joins us this morning on the Ag Issues program here on 580 WIBW.